Be fearful when others are greedy, and greedy when others are fearful. If you have spent any time following Warren Buffett, you have heard that sentence. Most people in finance can quote it verbatim. They write it on sticky notes. They repeat it in conversations. They share it when markets are calm and sentiment is high. And then the actual moment arrives. Silver drops 30% in a matter of weeks. The headlines turn dark. The forums fill with warnings and hand-wringing. And those same people who could quote the sentence do the exact opposite of what it says. They freeze. They wait for things to stabilize. They tell themselves they will buy when there is more certainty. And then the opportunity closes, prices recover, and they are still on the sideline, quoting Buffett's sentence to someone else. This video is about what to do when the moment actually arrives. Let us start with the simplest possible reframe, because it is the one that makes Buffett's approach concrete and non-abstract. When your favorite clothing store puts everything on sale at 30% off, your behavior is automatic. You do not stand outside and worry that the sale is a sign of the store's impending collapse. You do not call friends with warnings. You go in, you pick up what you wanted, and you feel good about the purchase. The price went down on something with real known value, and lower prices on real value is the definition of an opportunity. Now take that exact same logic and apply it to silver. Silver just had a 30% sale. The metal did not change. The geological scarcity did not change. The industrial applications did not change. The supply-demand math did not change. The price, the number attached to the same underlying thing, went down. Everything your behavior at the clothing store tells you to do, Buffett's entire framework also tells you to do. The reason most people cannot make this translation is well documented in behavioral economics. With consumer goods, people have a clear, intuitive sense of what something is worth independent of today's price. You know a shirt is worth wearing even if it is on sale. You know chicken is still edible even if it is discounted. The price drop does not change your assessment of the underlying value. But with financial assets, silver, stocks, real estate, most people derive their sense of an asset's value from its recent price behavior. If the price is rising, they feel the asset is valuable. If the price is dropping, they feel the asset is losing value. This is exactly backwards from rational buying behavior, and it is the source of the Dalbar gap, the documented difference between what markets return and what average investors actually earn. Buffett applies consumer logic correctly to financial assets. That is his edge. This video has two specific goals. First, show you the complete historical record of what happens after every major silver crash in modern history, not hand-picked examples, the full record with real numbers. Second, walk you through exactly what Buffett's framework prescribes when you are living through a significant price decline in an asset with solid fundamentals. By the end, you will have both the historical context and the practical framework. And a 30% decline will look very different than it did when this video started. If the way Buffett thinks about prices versus value resonates with you, subscribe to this channel. We break down how money and markets actually work, not how they appear to work on the surface. No jargon, no hype, just honest mechanics. Subscribe and turn on notifications so you catch every video. Let us go through the historical record now, because this is where speculation ends. Silver has had 6 major price crashes of more than 20% in the past 25 years. I am not selecting 2 or 3 that happen to support a thesis. 6 separate events, all publicly verifiable with basic price data from any financial data source. And the pattern across all 6 is identical. The price dropped sharply, sentiment turned intensely negative, most retail participants sold or avoided, and then prices recovered, exceeding the pre-crash level every single time without exception. The 2008 crash, Silver entered 2008 at approximately $20 per ounce. By October 2008, at the deepest point of the global financial crisis, silver had fallen to approximately $9, a decline of roughly 55%. Banks were failing. Lehman Brothers had collapsed in September. The financial world was in genuine structural crisis. The sentiment in silver was as negative as it could get, partly because silver had no systemic importance. No bailout, no government support, no too-big-to-fail status. It was just an asset that was falling. And from that $9 low in October 2008, silver began to recover. By April 2011, it reached nearly $50 per ounce, a gain of more than 400% from the 2008 bottom. The crash was not the end of silver's story. It was the setup for the next chapter in that story. The 2011 crash came after silver hit its modern peak at approximately $50 per ounce in April of that year. It dropped dramatically from there, losing nearly half its value over the following months, eventually stabilizing in the $25 to $30 range for an extended period. The public narrative at that point was clear. Silver was a speculative bubble that had run its course, inflated by excitement that the fundamentals could not support, and the crash confirmed what the skeptics had been saying all along. What the narrative missed was that silver's industrial demand continued growing throughout that entire period, that mine supply remained constrained, and that the monetary fundamentals driving dollar weakness had not resolved. By 2020, silver broke through $30 again. By 2023 and 2024, it exceeded its 2011 highs. The people who held through the post-2011 decade and added to their positions were eventually right. The people who sold on the bubble narrative crystallized real losses. The 2020 crash is the most instructive for our purposes because it was so sharp, so recent, and the reversal was so rapid that it provides the clearest possible illustration of the mechanism. In March 2020, as the pandemic began to spread globally and markets entered crisis mode, silver dropped from approximately $18 per ounce to $12, a decline of more than 30% in a very short window. Forced selling drove the price down. Funds with silver positions needed cash immediately to meet margin calls elsewhere. The price disconnected from fundamentals because of liquidity pressure, not because anything changed about silver's supply-demand math. And then, within 6 months, by August 2020, silver was trading at $29 per ounce, from $12 to $29 in 6 months, more than 140% from the panic low. The people who bought at $12 did not need a sophisticated strategy. They needed a framework that told them fundamentals unchanged, sentiment at maximum negative, price disconnected below fair value. Act. There are 2 other major crashes worth noting before we move to the mechanism. In 2014 and 2015, silver dropped from approximately $22 to under $14. A decline of nearly 40% over roughly 18 months. The catalyst was a combination of dollar strength as the Federal Reserve began signaling rate increases and declining commodity prices broadly. The narrative during that period was that commodities were in a structural bear market, that the era of high precious metal prices was over, and that silver had no fundamental support. What the narrative missed was that industrial demand continued growing, mine development was being curtailed by lower prices, meaning future supply was being constrained, and that the monetary case for silver had not resolved. Silver recovered from the 2015 lows and eventually exceeded the pre-crash price by 2020. The 40% drop in 2014 to 2015 was, in retrospect, one of the best buying opportunities in that decade. It felt terrible while it was happening. The pattern across all 6 of these crashes is the same, and it is not coincidence. It has a cause. Understanding that cause is what gives you the confidence to respond correctly when you are inside the next one, rather than being swept along by the sentiment of the moment. Write in the comments, "I buy when others panic." That is the Buffett instruction applied to this specific situation. I want to know how many people watching this are building that capacity, the capacity to act on a framework rather than react to a mood. Here is why the drops happen so suddenly and so dramatically. Silver is a relatively small market compared to gold, equities, or bonds. When large institutional investors, hedge funds, sovereign wealth funds, proprietary trading desks face a liquidity crisis, a margin call, or a sudden mandate to reduce risk, they sell whatever is liquid quickly. Silver is liquid. Large positions can be sold in hours. When multiple large sellers hit the market at the same time, the price drops fast, much faster than it would in a deeper, more liquid market. The key point is that this selling is driven by the seller's liquidity needs, not by any change in silver's underlying value proposition. The price drops because sellers need cash. The silver sitting in that price drop is the same silver it was before the drop. 1 ounce of silver with 30% lower dollar price is still 1 ounce of silver. There is a distinction here that is worth making very precisely. There is a fundamental difference between an asset losing value and an asset losing price temporarily. When a company goes bankrupt, it loses actual value. The operations cease. The future earnings disappear. The physical assets are liquidated at a fraction of book value. The company's underlying ability to generate value has been destroyed. Silver is not a company. It does not have operations that can fail. It does not have earnings that can disappoint. It does not have management that can make catastrophic decisions. 1 ounce of silver is a physical element. Its weight is its weight. Its purity is its purity. Its industrial utility, in solar panels, in electronics, in medical devices, in EV battery management systems, does not change when the dollar price on a screen moves. The price changed. The ounce did not. Why do the recoveries happen consistently? Because after panic selling drives price below the level that supply-demand fundamentals support, structural buyers step in at multiple levels simultaneously. Industrial users who need silver for production continue to buy because their manufacturing processes require it, regardless of short-term sentiment. These are electronics companies, solar panel manufacturers, EV assembly plants. They are price-sensitive in a general sense, but they cannot stop buying silver just because the price dropped. Their production continues. Monetary buyers who have been waiting for a better entry point see the discount and act. Long-term investors who understand the fundamentals recognize the mispricing and add to positions. The combined buying from these multiple sources absorbs the panic-driven supply. Demand reasserts above supply at the lower price level, and price begins to recover every time. Now here is something most people miss entirely when they are watching a silver crash unfold. The structural demand that drives silver's recoveries does not pause because the price dropped. Solar panel manufacturers are still building panels this month. The silver embedded in each panel is still required. Electric vehicle assembly plants are still building cars this month. The wiring and battery management systems still require silver. Electronics companies are still producing smartphones and laptops. Hospital supply chains are still sourcing antimicrobial materials. The Silver Institute documented that annual silver demand exceeded mine supply by hundreds of millions of ounces per year from 2021 through 2023. A price crash does not close that gap. The deficit continues. The fundamentals continue accumulating in favor of recovery, building pressure beneath the depressed price, until eventually the weight of that pressure is too great for sentiment to hold down. That is the mechanism. That is why the recoveries happen every time. not because silver is popular, because the demand that requires it does not stop when the price does. Buffett has been explicit about this pattern across his entire career. In his 1986 shareholder letter, he wrote about what creates buying opportunities. The most common cause of low prices is pessimism, sometimes pervasive, sometimes specific to a company or industry. We want to do business in such an environment, not because we like pessimism, but because we like the prices it produces. This is not a complicated idea, but it requires something most people find very difficult: the ability to act when the emotional environment is telling you not to. When silver drops 30% and pessimism is at its peak, Buffett's framework says this is the environment he looks for, not the environment he avoids. It is worth looking at how Buffett himself entered his silver position, because the context around that purchase is a direct illustration of the principle in action. When Buffett accumulated approximately 130 million ounces of silver in 1997 and 1998, roughly 30% of global annual mine production at the time, silver had been in a prolonged multi-year slump from its previous highs. The prevailing sentiment was that silver had no future as a monetary asset, that industrial demand was being replaced by substitutes, and that the smart money had already moved on. Buffett ignored the narrative completely. He looked at one thing: the supply-demand data. Annual industrial and monetary consumption of silver was consistently exceeding annual mine production. More silver was being consumed than was being produced. A real scarcity was developing beneath the surface of the negative narrative. He bought into the pessimism because the pessimism was creating prices below what the fundamentals supported. He was right. He almost always is, using exactly this framework. If the pattern in the historical record is becoming clear to you, if you are beginning to see why this drop looks different from how the headlines are framing it, hit the like button on this video. It helps more people find this channel at exactly the right time. Now let us talk about the psychology in detail, because understanding what is happening in your mind during a 30% drop is what gives you the tools to override it with a framework rather than react with instinct. When silver drops sharply, every information input you receive reinforces the same message: things are getting worse. The news articles headline the percentage decline. Financial forums fill with stories from people who are losing money and scared. The people you know who own silver are quiet or defensive. Charts show a line going down, and your brain, specifically the amygdala, the part that handles threat recognition and fear responses, interprets this environment as danger and produces a strong impulse toward escape. Get out. Protect what you have. Wait for safety. This is not irrationality. It is a biological response to perceived threat. The problem is that a falling price is not actually a threat, the same way a predator is a threat. But the brain does not make that distinction automatically. Ben Graham's Mr. Market framework is the most useful mental model for managing this. Graham, Buffett's mentor and the father of value investing, described the market as a business partner who shows up every day with a price. On good days, Mr. Market is euphoric and wants to buy at high prices. On bad days, he is depressed and wants to sell at low prices. Here is the critical insight. You are never obligated to trade with Mr. Market based on his daily emotional state. His mood does not change the value of what you own. If silver's fundamentals are intact, if the supply-demand math is the same, if the industrial demand drivers are still accelerating, if mine supply is still constrained, then Mr. Market's depressed offer price is a mispricing that creates an opportunity, not information that should drive your decision. The only mistake is confusing Mr. Market's current mood for an accurate assessment of value. Dalbar's annual research on investor behavior demonstrates the cost of following Mr. Market's mood rather than a framework. The quantitative analysis of investor behavior study has tracked the gap between index returns and actual investor returns for decades. The gap is consistently large, not because investors chose bad assets, but because of timing. They add money when prices have been rising and remove money when prices have been falling. The technical name for this behavior is performance chasing, and its inverse is capitulation. In silver specifically, the pattern appears in every major cycle. Retail participation increases as silver rises toward highs and falls dramatically during price crashes. The people who underperform are buying the highs and selling the lows. The people who outperform reverse this sequence mechanically, systematically, using a framework. The behavioral economics term for why this happens is loss aversion, documented extensively by Daniel Kahneman and Amos Tversky. Their research found that the pain associated with a financial loss is experienced approximately twice as intensely as the pleasure associated with an equivalent gain. A 30% drop in silver's price is felt emotionally as if it were a 60% loss in actual value. This asymmetry in how losses and gains feel is what makes the selling impulse during drops so powerful and so hard to override through willpower alone. Pre-committing to a framework before the drop happens is the only reliable way to override this bias when you are inside the drop. If your framework says, before any crash, when silver drops more than 20% and the fundamentals are unchanged, I buy more, then the decision was made before the emotional pressure of the moment. You are executing a plan, not reacting to a feeling. Let us get to the 3 questions Buffett's framework uses to evaluate any significant price decline. First, does this asset go to zero? This is the risk of ruin question. Silver has existed as money and as an industrial material for 2,500 years. It is a physical element with a fixed atomic weight. It cannot be recalled, can't go bankrupt, and cannot be printed into worthlessness. An ounce of silver is always worth the value of its silver content, which is always above zero, because industrial demand alone creates a floor. The answer is no, silver does not go to zero. Second, has the fundamental case changed? The Silver Institute's supply-demand data, the solar panel demand trajectory, the EV adoption curve, the mine's supply constraints, none of these change because the dollar price of silver moved. The fundamental thesis is intact through the price drop. The answer is no, the case has not changed. Third, is the current price below what the fundamentals support? After a 30% decline in a market with documented annual supply deficits, where demand has exceeded production by hundreds of millions of ounces per year, the answer is almost certainly yes. All 3 checks pass. The framework says, act. If you have been sitting on the understanding that silver has a strong fundamental case, but have not moved from knowing to doing, check the first pinned comment below this video. It is there for people who are at that specific junction and are ready to bridge the gap. Let us also be specific about what the entry process actually looks like for someone who has decided to act on this framework during a price decline. Physical silver, the most direct form of ownership, is purchased from reputable dealers. The most recognized options in the US include APMEX, JM Bullion, and SD Bullion, all of which are established, heavily reviewed, and straightforward to use online. You go to the site, select the coins or bars you want. 1-ounce American Silver Eagles are the most widely recognized and easiest to resell later. Add them to your cart, enter payment, and the silver arrives at your address in padded, secure packaging within a few business days. No financial advisor required, no account minimum, no approval process. If you can buy something on Amazon, you can buy silver from a reputable dealer. The entry barrier is entirely mental, not practical. And during a 30% price decline, the mental barrier is the only thing standing between you and a more favorable entry price than you have had in months. The specific execution that applies Buffett's framework without requiring perfect timing is consistent dollar cost averaging. Buy a fixed dollar amount of silver on a regular schedule, regardless of what the price is doing that month. When silver is at its highest, your fixed amount buys fewer ounces. When silver is at a 30% decline, your fixed amount buys significantly more ounces. You do not need to identify the exact bottom. You do not need to predict when the recovery starts. You accumulate ounces at the discounted price while the market remains depressed. When the price recovers, as the historical record shows it consistently does, your average cost per ounce is well below the recovery price. This is not a complicated strategy. It is patient, mechanical consistency applied to an asset with sound fundamentals. Most financial frameworks that include precious metals suggest 5 to 10% of liquid savings as a baseline position in silver and hard assets. During a significant price correction of 30% or more, investors who are aligned with Buffett's framework often choose to temporarily increase that allocation, buying more while the price is depressed, then returning to the base allocation as prices recover. This is the direct practical application of greedy when others are fearful. The fear in the silver market during a major crash is creating the price you pay. You can act on that pricing, or you can wait until the fear subsides, the price recovers, and you are buying at the same price as everyone else who waited. There is one more practical consideration that distinguishes people who successfully hold through price drops from people who sell at the worst possible time: position sizing. If you have put an amount of money into silver that makes the 30% decline feel like a financial emergency, if you are thinking about it constantly, calculating your paper loss every day, unable to sleep because of the position, that amount is too large for your current comfort level. Buffett's approach to position sizing is directly tied to conviction and to the ability to hold without panic. He once described his preference for owning positions he could hold through a 50% decline without losing sleep, because he was confident in the underlying fundamentals. If your silver position is sized to a level where a major price drop feels manageable, 5 to 10% of savings for most people, then the drop is much easier to hold through. And holding through is what produces the recovery gain. The total picture, from the perspective of someone who held through each of the 6 major crashes in the past 25 years, is remarkably consistent. Every crash felt convincing at the time. The narratives explaining why silver was broken were compelling. The 2011 bubble narrative, the 2020 pandemic everything is falling narrative, the 2015 interest rate rising dollar strengthening narrative. Each one had logic behind it. Each one was ultimately wrong in predicting that silver would not recover. The fundamentals, geological scarcity, industrial necessity, documented supply-demand imbalance, are not changed by narrative. They are the weighing machine. The narrative is the voting machine. Long-term, the weighing machine wins. One more data point that brings the opportunity into sharp focus. From 1971, when Nixon closed the gold window and the dollar became fully fiat, to today, the dollar has lost more than 85% of its purchasing power. Silver, over that same 54-year period, has gone from $1.50 per ounce to approximately $28 to $32 per ounce today. The dollar went down. Silver, measured in those weakening dollars, went up, because silver's physical quantity could not be manufactured by political decision while the supply of dollars could. A 30% drop in silver's dollar price is a short-term sentiment event layered on top of a 54-year structural trend. The short-term event creates the entry opportunity. The long-term structural trend is what the fundamentals support. These operate on completely different timescales, and confusing one for the other is the mistake that causes people to sell at the wrong time. What you are buying when you purchase silver at a 30% decline is not a declining asset. It is the same ounce of silver, the same weight, the same purity, the same 2,500-year monetary history, the same role in 6,000 industrial applications, the same position in a market with documented annual supply deficits at 30% less than it cost last month. The ounce did not change. The price changed. Buffett has said this about assets in general more times than can be counted. Price is what you pay. Value is what you get. During a 30% crash, the gap between price and value, the gap between what you pay and what you get, has widened in your favor. That is the definition of a better deal, not a worse one. Honesty requires acknowledging what this approach demands. It demands that you feel uncomfortable and act anyway. It demands that you read bad headlines and move toward what they describe rather than away from it. It demands that you override a fear signal that is real and strong and evolutionarily ancient, with a framework built on data, historical record, and supply-demand fundamentals. This is not easy. If it were easy, everyone would do it, and the discount would not persist long enough to exploit. The discomfort is not a flaw in the approach. The discomfort is the mechanism that creates the opportunity. When most people cannot hold through the discomfort, the price stays depressed long enough for the people who can hold to accumulate at favorable prices. Then the fundamentals reassert, then the price recovers. The people who held through the discomfort are sitting on gains. The people who sold into the discomfort are watching the recovery from the sideline. This has been the pattern consistently in every major silver crash of the last 25 years. Look at the specific contrast between two behaviors during the 2020 crash. Someone who owned $500 of silver in February 2020 at $18 per ounce held roughly 28 ounces. When silver dropped to $12 in March, that $500 position showed a paper loss of 33%. Person A sold to stop the bleeding, to wait for clarity, to feel in control of something. They locked in a 33% loss. By August 2020, silver hit $29. Those 28 ounces, had they been held, would have been worth $812. 62% above the original purchase. Person B held through the same decline, the same discomfort, the same dark headlines. Person B's $500 became $812. The gap between Person A and Person B was not information. They had the same information. It was the framework applied when the emotional pressure was highest. The people who are sitting in the shade today are not the ones who waited for certainty before planting. They are the ones who planted when the ground looked uncertain, when the price was down, when the narrative was negative, when every signal in the environment said wait. The tree does not care whether the weather looked good on the day it was planted. The tree grows regardless. Silver's fundamentals do not care whether the short-term sentiment was positive or negative when you bought. The supply-demand math, the accelerating industrial demand, the geological scarcity, these grow regardless. The question is whether you plant when the opportunity is in front of you, or wait until everyone else sees it and the opportunity has already closed. If you stayed until the end of this video, write in the comments, "I see the sale." There is another video ready for you on screen right now, the next piece of this story, including exactly how to start owning silver for as little as $50 and what to look for when you do. Thank you for watching. We will see you in the next one.